Hello everyone, Valdestot here, and on today's video, this is going to be a video describing the tax implications for the majority of drivers. Okay, so this is going to basically detail the future 2021 tax returns and how it can implicate drivers who take longer distance orders versus shorter distance orders based on the income that you make. And simply put, we use the dollar per mile as the basis. So should a driver take more than $1 per mile or less than $1 per mile? It all depends on your situation. So here we go. This is not going to be a one shoe fits everybody lesson, okay? I'm going to give multiple examples that kind of describes the general method of what's going to happen if you do one of these types of examples based on your situation and how the taxes are going to affect you in 2021. So, starting with the 2021 mileage deduction taken straight from the IRS standard mileage rates. You can see I highlighted that we as drivers running our own businesses as 1099 independent contractors will get 56 cents per mile in 2021, which is this year. So if you've already driven, let's say 10,000 miles, you're going to get 56% of that. Basically $5,600 as a deduction to reduce your taxes. Here are the rules. Okay, a lot of you drivers, the newer ones out there, don't know what to expect. Some people get, like Bentley Coupe, gets mileage deductions versus mileage credits confused. There is no mileage credit. That means if you go over a certain amount or reduces your tax below $0, you don't get a credit for that. All a deduction literally is it just reduces your amount of gross income, so that when you finally get to the adjusted gross income or taxable income, that figure is what's going to be used to calculate your taxes. Okay, so here, there's a standard versus itemized way of determining your mileage deduction. So the two options are the standard mileage deduction. Most straightforward way, 56 cents per business mile. Okay. The second way is the itemized, the actual expenses. It's a lot more legwork, but if you are spending a lot more money, let's say on repairs to your car, it may be worth doing that, because look at the line items for the actual itemized expenses. Okay, depreciation of your car, licenses for your business or car, lease payments, registration fees, gas and oil changes, insurance, which is for your auto insurance, repairs, garage rent, tires, tolls, and parking fees. So you're thinking, well, why wouldn't I do that? Sometimes drivers don't have a lot of actual expenses, especially the drivers that don't drive a lot of miles. So it all depends on which way you want to go. If you want less paperwork, less having to remember and record receipts for everything that you do, go with the standard mileage deduction. But if you are the type of driver that literally has a lot of expenses, then go with the itemized. So remember, it's 56 cents per mile in 2021. And in Section 2, this is their definition. Section 162A allows a deduction for the ordinary and necessary expenses a taxpayer pays or incurs during the taxable year in carrying on any trade or business, including the cost of operating an automobile to the extent that it is used in a trade or business. Under Section 232, a taxpayer may not deduct any portion of the cost of operating an automobile attributable to personal use. So by the letter of the law, you must be on an active delivery in order to claim those miles, which is why I use the dollar per mile method. If you make $30,000, chances are you've driven 30,000 miles. It's just that simple. But in other cases, some people may count, which they shouldn't, round trip miles from your home. Let's say you don't have a delivery when you leave your home, but you want to drive to your location to start delivering. The mileage from your home to that point with no active delivery is actually not deductible. And if the IRS really wanted to be difficult, they could audit you and you would have to prove the miles that you actually claim. So if you wanted to be criminal about it and lie and just say that just to reduce your taxes, oh, I drove 75,000 miles when you in reality only drove 30,000 miles, yeah, you're gonna get penalized hard. I don't recommend doing that. So, first of all, I am not a tax professional. I am not an accountant. I'm just some random dude on the internet that has done his own taxes with his accountant that knows at least what he's talking about based on his own taxes. Okay, so I'm just telling you the information based off the IRS site and the different scenarios that could happen. So don't get mad at me if there's something wrong on your end that worked on my end. Always consult an accountant or a tax professional before filing your taxes. There's my disclaimer. So here are the tax deduction rules for the standard deduction on the 1040 forms, okay? So as you can see here, I highlighted, not really highlighted, I circled the tax deduction amounts, okay? So for tax year 2021, adjustments described below generally apply to tax returns filed in 2022, which is next year. The tax items for tax year 2021 of greatest interest to most taxpayers include the following dollar amounts. The standard deduction for married couples filing jointly for the tax year 2021 rises to $25,100, up $300 from the prior year. So that means if you are married, okay? So for single taxpayers and married individuals filing separately, the standard deduction rises to $12,550 for 2021, up $150, and for heads of household, the standard deduction will be $18,800 for tax year 2021, up $150. The majority of you will most likely fall under the single taxpayer or the joint married couples taxpayer, okay? There are head of households, okay? But again, I'm not going to cover that. So, as you can see, online I went to the IRS website and they have draft versions as of September 21st, okay, 2021. Now, what that means is this. This is not 100% finalized. These are drafts of the IRS thinking these are going to be the tax rates based on the taxable income amounts. As you can see on the first page, it goes from 3,000 to 11,000, and in the tables below, everywhere in between. Okay, so 3,000 to 4,000. Those numbers right there. It'll say single, married, filing jointly, head of household, and other. Right. So if you fall in between that range between, let's say, 3,000 to 3,100, you would look under the single or married filing jointly or whatever you are, and you would see your actual tax amount that you would owe the IRS. So, tax based on pay and mileage examples, number 1. This is examples illustrating a driver making $30,000 a year with no spouse, no children. Just basically the driver alone is the only person that is involved in this tax return. All right. So based on the 2021 individual standard deduction of $12,550 with 30,000 business miles driven using a dollar per mile minimum rule. Basic deductions, no other factors involved, including self-employment tax, Social Security tax, etc. Okay, not even the child tax rate, nothing. Okay, this is just basic of basic information so that the drivers out there can at least get a gauge of what to expect based off of the non-finalized tax tables. Okay, so as you can see on the spreadsheet, gross income of $30,000, standard mileage deduction of 30,000 miles at 56 cents a mile, that deduction amount would be $16,800, plus your standard personal deduction as a single person of $12,550. The adjusted gross income / taxable income amount would be $650. And based on the tax tables shown before on the slide earlier, you would pay $66 off of $650 using that draft tax chart. So the driver would owe $66 in taxes. Now, keep in mind, this does not take into account any self-employment or Social Security taxes owed. There are supposed, as business people, as independent contractors, we are supposed to pay quarterly taxes. I do. I pay it every 3 months or 4 months depending on the quarterly due date. Okay? I usually pay about 180 something dollars. Okay, actually, I'll look. I have it right here. For calendar year, okay, of 2021, for the fourth quarter, which is due on January 18th, 2022, I have to send a 2021 Form 1040 ES payment voucher, and I've already paid 3 already, so this is the fourth one, which isn't due until January 2022. I have to pay $181 every 4 quarters, every quarter for 4 quarters in a year. So I don't have to be burdened with a Social Security Medicare tax on my tax return. I'm proactive like that. A lot of drivers aren't, and you will owe that. This does not include that in this presentation. I'm just showing you basic miles to income and your tax hit based off of that. So, does that make sense? Good. This just illustrates the tax based on gross income mileage deduction off of different scenarios based on the household count. This would be a scenario where it will be tax neutral. This scenario number 1, tax neutral, because anything under like $200 is pretty tax neutral, okay? That means $0 owed to about $200 in that range. So there really is no real benefit driving long distances if you make $30,000 a year with no spouse, no children, and based off of the 56 cents a mile. You don't want to drive long distances. There's no point. If you drive less than $1 a mile, there is no benefit. You're wasting miles because your taxes are, you're only going to basically reduce $66 to 0, and anything over that you lose. There's no benefit. There's no write-off. There's no credit. So if you make more than $1 a mile, then your income and taxes, of course, would increase. Okay. Example 2. Drivers making $30,000 a year with spouses but no children. And I'm not going to include children in any of this because the bottom line, and I'll explain that later, okay? Based on the 2021 individual standard deductions of $25,100 with 30,000 business miles driven using a dollar per mile minimum rule, basic deductions, no other factors involved, including self-employment tax, Social Security tax, earned income credit, etc., right? Gross income is $30,000. Standard mileage deduction would be $16,800 like before, but the personal deductions increased to $25,100 from the earlier amount, right, of around, what was it, about $12,550, right? So the adjusted gross income, taxable income, is actually in the negative by almost $12,000, exactly $11,900. You wasted almost $12,000 driving 30,000 miles because your spouse impacted your deductions. It increased your deductions. So realistically speaking, you just lost all that mileage for nothing. So the driver would owe $0 in tax. Again, doesn't take into account any self-employment or Social Security taxes owed. This is just to illustrate the tax on income and mileage deductions, right? Based off the household count. This would be a scenario where it would be stupid to drive long distance trips making under $1 a mile. I mean, it makes no fiscal sense to do it. All right. There would be no tax benefit as you do not receive any overages as a result of the mileage deduction. Remember, this is not a credit like Bentley claimed it was back in that video a few months ago. This is a scenario where you would try and make at least $1.50 or more a mile to take advantage of this overage in the mileage deduction. Avoid under $1.50 or less offers if you are married. Here's the third example. Drivers making $60,000 a year with no spouse, no children. The hustlers, the multi-appers, right? They are in it to make the money. Okay, these are the people that just want to make it. It's 60,000 or more, right? These people want their money. So the gross income for this is $60,000 a year. Standard mileage of 60,000 miles. Remember, dollar per mile at 56 cents per mile. $33,600 for the deduction. Standard personal deduction as a single person is only $12,550. The adjusted gross income, taxable income, becomes $13,850. So based off that tax table, you would have to pay $1,466 in taxes, and that's not including, as I said, self-employment tax, Social Security tax, or whatever, right? So you would owe $1,466 in taxes. This illustrates the federal tax based on the gross income mileage deduction, as I said before. This would be a scenario where making $1 per mile or higher is actually bad if you don't want to pay any taxes, because the more you make, the more you have to pay in taxes, obviously, right? This would be the rare time to want to drive extra miles for under $1 a mile if your goal is to not pay taxes. I know what some of you are thinking, well, the more money I make, it's actually going to offset the taxes. That's true, but this presentation is just to illustrate that if you just don't want to pay any taxes at all or drive the proper amount of miles, no more or no less, to zero your taxes as close as it can to be to zero, okay, that's what this is about. So the bad thing about this is, the problem with doing this scenario is that your car would be having mileage issues after 3 years, all to just avoid paying taxes. I mean, you're talking 180,000 miles in 3 years or more, okay, because we're just basing it off of $1 per mile. Some people could be getting $1.50 to $3 a mile in some areas, right? You guys are going to be in for a rude awakening when tax time comes. So anyway, the final example is drivers making $60,000 a year with a spouse and no children, okay? So same thing applies. 2020 individual standard deductions of $25,100, 60,000 business miles using $1 per mile minimum, no other factors, self-employment tax, Social Security tax, earned income credits, nothing like that, right? So gross income is 60, standard mileage deduction would be 33.6. Standard personal deduction as a married filing jointly couple would be 25.1. The adjusted gross income, taxable income, would only be $1,300. Okay, so using the 2021 chart would be $131 owed in tax. It illustrates just the tax on gross income compared to the mileage deduction. We've said it over and over. I just want to drill this into your head, okay? This would be a scenario where making $1 per mile is about where it needs to be tax-wise, okay? The problem is that your car would still be doing excess miles. 60,000 is 60,000 miles, right? So 180 to 200,000 miles, depending on if you drive more or a little less, right? So any increase in pay or decrease in miles would cause your taxes to increase, okay? So here's the bottom line. It all depends on the amount of personal deductions you have. Remember I said I'd talk about it later? Well, now is later, okay? Or later is now. So the larger the family you have, the less miles you can drive in order to take advantage of the mileage deductions. So if you got kids, that's 2 more deductions on your tax return, okay? And not to forget about the earned income credits based on, earned child tax credits based on the amount of kids you have, which would then give you money back. These aren't deductions, these are credits now for each kid you have. So the bigger your family, the less you literally have to drive and the pickier you can be in order to not kill your car. So any mileage overage that takes the tax to $0, okay? Or in the negative is wasted miles, as I said before. There is no carryover on mileage to the next tax year. No drivers will be exactly the same because of different income and deductions, okay? One driver may have no kids or not even married. Or they could have kids but not married. Or they could be married with, 10 kids. I mean, it just all depends. So hope this simplified income mileage tax presentation helps drivers understand their future 2021 tax return implications. Okay? Leave a comment below to help other drivers get your experiences when you guys did your taxes. Take care, everyone, and have a great day.